morning, everyone. And thank you for attending the Place Your Trades Network Spaces to discuss energy markets. This Spaces is brought to you by TraderBait, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energy, metals, and now Bitcoin. You can trade these now on the DOM on TraderBait's main platform or on the app. They're a great way to get exposure to the futures market with defined risk. You can use the link in my Twitter stream to get the TraderBait app for free. I also write a weekly blog on markets that you can find at placeyourtrades.com. Access is free. You just sign up. And now to introduce our guests. First, we have Dan Pickering. Dan is Chief Investment Officer at Pickering Energy Partners, PEP. PEP is a financial services firm focused on investments and advice in the energy sector, both traditional oil and gas and energy transition. Prior to PEP, he served as president of Tudor Pickering Holt & Company and chief investment officer at TPH Asset Management. He spent 29 years as an energy portfolio manager, researcher, and analyst, first at Fidelity Investments, where he managed $1 billion of energy sector funds, then as head of research at Simmons and Company, and as founding partner of Tudor Pickering and Holt. He currently serves as the portfolio manager of PEP's Energy Equity Strategy and is on the investment committee of PEP's Energy Co-Investment and Private Equity Strategies and serves as various business development and oversight roles within the firm. Next, we have Ira Joseph. Ira is Global Fellow at the Center on Global Energy Policy at Columbia University. Until 2022, he was Global Head of Global Generating Fuels and Electric Power Pricing at S&P Global Platts, with over 30 years experience in the sector. Prior to his pricing role, he was Global Head of Gas and Power Analytics at Platts. Ira joined S&P Platts during the acquisition of the Pura Energy Group in 2016, where he started the firm's European gas and power and global LNG services in 1999. Before Pura, he worked at Energy Intelligence Group, where he was the editor-in-chief of the World Gas Intelligence and authored versions of the International Crude Oil Handbook and the original Global Gas Handbook. So welcome, gentlemen. Thank you so much for taking time out of your day to speak with us. How I do this, since you guys are new, I do this in the round, so nobody's sitting quiet for that much amount of time. I can't speak today. And if you have comments on what the other one says, feel free to comment. Don't feel like you don't have to.
Thanks,
first, yes. So first, we'll start with Dan. So first, what everybody's talking about is the shale boom over, with companies kind of focusing on investor returns, stock buybacks, paying down debt versus capex. There's a lot of talk, and there's a lot of talk that the shale boom is kind of dead. And if you want to expand on that and talk a little bit about decline rates and acreage and things like that.
Sure. And Tracy, I'll kind of keep my comments relatively brief. We can always come back and talk more about them. And I assume there will be Q&A on this and we can come back to it. But so I think shale's far from dead as kind of a production story in the US. It is plateauing. And by plateauing, I mean, wells are not getting better anymore. And particularly at current well costs, the economics are not as compelling as they were a couple years ago. And so I think that we've drilled many of the sweet spots. That's what you typically do in any play, is you drill the best stuff first, and then you move on to tier 2 and tier 3 acreage over time. And I think that's what we're going to do here with shale in the US. But if you look at Permian's 5 million barrels a day, I think it'll go higher. I think US production generally will go higher. But it's going to take more rigs than we've been using. So productivity is starting to roll. We've seen that in the Permian. We're seeing it in other basins. And so, and what I think we're also seeing is we're seeing all sorts of indicators that companies don't feel like they've got enough inventory on an ongoing basis. There's been upspacing announcements by Conoco, Devon. When you upspace, what's that mean? Fewer wells, which means you have less wells to drill on any given amount of acreage. You need more acreage. You're seeing acquisitions across the board, multi-billion-dollar acquisitions happening. Ovintiv, Diamondback, Devon, Marathon have all made acquisitions. And so I think that the industry is telling you they need more inventory. It's going to be hard to maintain current levels of production. Decline rates on initial wells are 50+%. And so, we're battling a pretty steep decline curve. Net. Shale's far from over. It's definitely maturing, makes it harder to be an investor in the space. You got to be more selective. And I think it argues that, your marginal barrel is now getting more expensive, marginal global barrel, which supports oil price. I'll stop there.
And then kind of along that same vein, do you think, kind of 2016, we started really seeing a lot of mergers and acquisitions because, the shale would bust again at that time. Do you think that we've seen a couple this year, do you think that we're going to see more in this sector?
I do. The companies think that there's going to be fewer companies. The buy side investors think there are going to be fewer companies. I think there will be fewer companies. Why? Because when you move from a growth story to a value story, right? Wall Street has essentially told energy companies, don't grow your production. Well, if you're not growing production, why'd they say that? Because the U.S. essentially blew up the world in terms of global oversupply. We took every incremental barrel, we caused a price war, et cetera. So if you're not going to grow production, then how do you grow? Well, you use your cash flow to do something. They're using it to buy back shares and shrink the share count right now, dividends, et cetera. But you grow by buying other people, and you get scale by buying other people. I think ultimately what we're going to see is all of these very specific single basin companies. There'll still be some of them, but I think we're going to see kind of the recreation of these more global multi-basin companies, because that's what they're going to have to do to grow in a world where investors aren't going to let them grow volumes. They're going to grow by consolidation. So I think it's coming.
And now I kind of want to move this over to the Fed and rate hikes. So, right, Fed's obviously hiking rates the fastest manner in history, just about. So how is this affecting the oil and gas industry? And and physical commodity traders, right? Which require a lot of borrowing to buy and store commodities. So higher rates must be having an impact. Can you go into that a little bit?
Tracy, is that a question for me or for Ira, or both?
That's for you.
Okay, so higher rates, right? Cost of capital is going up. It's going up, because interest rates are up. It's going up, I think, because investors are generally, have been more skeptical of the sector, and therefore they're expecting a higher return. So when you think about the business, I think it's just the return expectations are moving up. The cost of capital is moving up. I don't think it materially changes the ability of the companies to operate, but I do think that to get folks involved, we're going to have to see better rates of return. The industry is delivering them, but they're going to have to keep delivering.
Thank you. And next, we'll move to Ira. We're going to talk about natural gas a little bit here and LNG. So first, let's dig into Europe a little bit. So Europe got really lucky with a mild winter. They seem to believe the energy crisis is behind them, as we've seen TTF prices falling back over 80% since the summer of 2022. Are they out of the woods yet?
Oh, yeah, no, I would say definitely not. I mean, we're looking at two different sets of woods here. I mean, there's the summer woods and there's the winter woods. So in the summer woods, it looks a lot better because we're going to end storage around 76 BCM, which is, it's not the highest ever. The highest was in 2022, peak COVID at this time of year. but it's so high that it's not. It almost seems like a matter of not when storage is going to be filled, if storage is going to be filled, but like when. But you can't be more full than full in storage, and that's really the issue. And at the end of the day, Europe has to balance on incremental imports to balance during the winter, and so that will always leave a risk premium. So right now, the risk premium, is not what it was last year. Winter prices are around $14 per million BTU. Prompt prices are around $7-8 per million BTU. But we, again, as you said, we had a warmer than normal winter last year. We don't even know what a normal winter is going to look like, let alone a colder than normal winter. So you can't be too bearish for too long here. But at the end of the day, European gas demand drops between the second week of February all the way through almost the end of September. So you're going to get large storage injections here. In LNG imports are very, very high, and injections were higher than really were needed than in May. So right now it's looking pretty soft, but you can't dismiss the winter, and you can't dismiss the risks that are coming into the winter. I mean, even if we did have the Russian gas, the risks would be there. So it still is something that I wouldn't say it's over. I would say some people I think in Europe are breathing easier, but I don't think anybody realistically thinks that that we're out of the woods yet.
Well, and they've kind of been reluctant to sign long-term contracts, right? Even,
right.
after last year.
Sure. Yeah, I mean the issue with the long-term contracts is what is your position going to be on Russian gas? Do you believe no Russian gas is coming back into the market, or pipeline gas, I should say, ever again? Do you believe half? Do you believe 10%? I mean, you're talking about 15 to 18 billion cubic feet a day of gas on an annualized basis, and so if some of that gas were to come back into the market, that the risk of signing a 15 to 20-year deal here, when the hole in the market really is realistically probably 2 to 4 years right now, is maybe something that may not be worth doing. So at the end of the day, I do think volumes are going to get signed up. I do think longer term deals. Of course, you saw the deal with Bangladesh that Reuters reported yesterday for 15 years. I do think deals will get signed, but I'm not entirely sure they're going to completely cover the space for what was lost in terms of Russian supplies.
So it'll kind of put them in a pickle again if they have a colder winter, right?
Yeah, I mean the winter issue, like I said, with or without Russian gas, is always going to be an issue. I mean the market balances on incremental imports, and there's not enough storage. And I mean I think that's another issue we can certainly talk about, is sort of as the marginal cubic foot or cubic meter of gas that's traveling around the world becomes LNG and not pipeline gas crossing borders, like what is that relationship to storage? And and I think it would be interesting to hear Dan's view on this too, about how much storage, and I'm talking here about capacity, not just volume, needs to grow in Europe. Does it needs to grow in the US? Obviously it needs to grow in Asia, because Asia has very, very little, and China's trying to rectify that. But that's unless you have the proper amount of storage relative to your peak demand, it's very, very difficult. And Europe, I don't think will ever really be in a position to sort of not balance on incremental imports during the winter. Although I think that number will get smaller and smaller over time, because European gas demand isn't really growing. It's just a supply substitution issue between Russian gas and LNG. And going forward, demand really hasn't grown weather adjusted for almost 20 years. So the issue is really just how to balance at these levels and at levels close to these. And maybe we see a drop off a couple % a year on weather adjusted basis.
And then kind of turning to the U.S., obviously everybody's wondering when nat gas prices are going to get off the floor,
Sure.
Although they're pretty much at their long-term average. We have seen a lot of nat gas rigs coming off, especially over this past month. When or will this even filter down into, say, lower supply?
I think it kind of has to at some point. I mean, short term, it's very, very hard, and Dan probably can speak to this much more eloquently than I can about on a short run marginal cost basis, where the break evens now are in all these basins. I've been kind of surprised that the volume hasn't come off either. We're still over 100 BCF a day, even as the rig count's going down. As I've said on Twitter, where we all know each other from. I mean, the gas to oil ratio, I think, is definitely an issue, and I'd be interested to hear what Dan has to say about that. But yeah, I mean, it's very, very hard to see us on a sustainable basis, getting much below these levels. You certainly are seeing a lot stronger power demand, especially in the second quarter here. I mean, we're up year on year, between 2.5 and 3 BCF a day, but we lost so much, and we have lost so much in the residential commercial level that on a domestic level, the balances have allowed prices to come down to this level. And just quickly, longer term on something Dan said, I mean, it's good to hear that he doesn't think shale is peaked because, probably 90 to 100% of incremental demand growth in the U.S. is going to come from feeding exports. And we're going to need to fill all these LNG projects another 10 to 15 BCF a day of gas. I know he was talking about oil, but from a gas perspective, it isn't like there won't be growth. There needs to be growth, even if you believe U.S. gas demand is peaked or is close to peaking.
Dan, did you have any comments on that?
Yeah, I'd love to weigh in real quick here. So at a very high level, going back to Europe, one of the things I think is interesting is I think that this crisis that Europe went through last year will kick off over the next, we're going to wind up probably oversupplied global gas. Why? Because everybody's looking at Europe saying, wonderful market, they're going to have to squeeze down Russia. And so I think you're seeing a bunch of incremental LNG projects around the world. Plus, you're going to have some, I think, pipeline projects develop in and around Europe, whether that, East, the Med, et cetera. And so I think Europe's smart not to be signing a ton of contracts when, TTF was 300. It's 30 right now. It's higher for the winter, but I think we've kicked off a big gas boom that will ultimately wind up with some amount of oversupply. When you look to the U.S., I don't think we have any shortage of gas. We got to find outlets for it. We have LNG projects coming, late next year and into 25. I think we're oversupplied sort of until then. The hardest part for me about gas is everything's it's very consensus right now. If you look, the 25 strips about $4, the 24 strips about $3.50, compared to a 2 and change spot price right now. And so we've cracked gas. Are we going to crack 24 gas before this is all over? I'm not sure. So the global market, I think, has plenty of gas. It's just a function of getting it to the demand centers. And so I'm probably in the same camp as everybody else in the world that says, gas is a story that you're just kind of waiting to really develop. And so I worry when there's so much consensus around something. So maybe that's reflected by 25 gas is $4 and should be $6. But so right now I'm kind of on gas for the next year. And so I'm
That's a technical term, right?
Exactly.
I like that.
That's right.
That's great.
It's definitely a technical term and a trading term. And so I'm watching. I think the world's watching. I just feel like it's probably dead money as an investment. So I'm more of a sometime in 24 owner, not a sometime in 23 owner.
Cool. And then back to Dan, let's talk about energy equities for a minute here. It seems, if we look at the S&P 500 sector performance year to date, the energy sector is doing the worst, right? So it seems that obviously there's a lot of money flowing out of this sector. Do you have any thoughts on why there is such a disinterest in the sector right now? I mean, do energy companies need to start mentioning AI on earnings calls next quarter?
I promise you, people will ask them how they're going to use AI to get oil out more efficiently. That's a guarantee. So kind of first to worst, 2 years, best group in the S&P, now the worst group in the S&P. Commodity hadn't helped. We were 100 plus last year. We're 60 something right now. OPEC's cutting. Why is OPEC cutting? OPEC, they're supporting price, but are they really, or would it be a lot worse if they weren't cutting? I think the answer to that is probably yes. And so right? Energy has been fighting this perception of a recession for a long period of time, right? We've been fighting the upcoming recession for at least 6 quarters. So folks are worried about the macro, appropriately so. If you look at the sector, though, let's think through what's happening on a micro level, at a company specific level. We just talked about shales getting worse on the margin. If you're in the OFS space, rig count has been going down, so that's the revenue driver there. So on the margin, the data points for the company specifics aren't that great. And this is a what are you doing for me right now kind of stock market, I think. And so tech is sucking all the oxygen out of the room. You know, we can debate if the market's sort of technically broken out with the S&P, hovering right around 4,200. And so people are selling energy because they call companies and it's not better than it was last time. It might be worse. And there are other things that are working that they're trying to chase. And I understand that the market's not very broad, and 20 stocks make up all the movement of the S&P this year. But at the end of the day, if you're way overweight energy and underweight tech, you're getting crushed. So I think folks are getting sucked back into tech. I think energy has a better second half than first half. I also believe that's pretty consensus. And so right now it's a knife fight to kind of get through what is a period where the commodity's not doing much and the company specific stuff's not doing much other than real meaningful cash flow that's being returned to shareholders. And so, I kind of don't mind to wait. I'm getting paid decent yields to sit around. And if the world turfs and we have our recession and, oil tests 60 and these names tank again, that's going to be a fabulous opportunity. So you kind of slog for a little while. If they turf, you really step up, and you're kind of in a waiting game right now.
And then kind of along that same vein, obviously, if we look at the benchmarks, WTI and Brent, obviously we've had poor participation within those contracts for months now, and this started in fall of 2022. We have sentiment at the lows. All the length is basically out of these contracts. What are your thoughts on this? And, how much dry powder do shorts have right now?
Yeah, so it feels like the market's trying to push OPEC to do something else, right? We come into this meeting and we're taking a chunk out of crude, trying to get OPEC to act. Shorts typically have a lot of dry powder. The financial market's a ton bigger than the physical market, and it feels like every bet's a macro bet right now. And so when you see things like, if the market's selling off and people are taking off risk, they're taking it off in commodities as well as equities. And so I think correlations are higher than they historically are between, oil and other macroeconomic indicators. So we kind of have one big trade happening. So I tend to think in bands. And I believe we're kind of in this sort of, I think $80 is the number that we'll trade at for the next 5 years on average. When you get into the 60s, that looks pretty cheap to me. When you get into the hundreds, it looks pretty expensive. And right now the macro trade is softer. And so, the money flow is more short than long. There'll be a squeeze at some point. Saudi threatened to make people ouch again. And I don't know if they will or not, but I don't mind seeing oil trade off here because I don't think it goes a ton lower, and then the snapback, just reminds people the market's reasonably tight.
Did you have any comments on any of that, Ira?
On the oil side, no. I think the last OPEC meeting I went to was in 1991, so it would be a little dangerous for me to comment at this point. I mean, I would say, in terms of oil production in the U.S., I do always like to remind people there's an inverted relationship between U.S. oil prices and U.S. gas prices. So, if U.S. producers would have to cut, I think that is somewhat supportive for Henry Hub going forward, because obviously on a dry gas basis, you're not going to have a lot of support. But when you start losing wet gas because of what's happening in the oil markets, that tends to be somewhat supportive for Henry Hub, even as oil is falling.
Okay, let's turn to, this is for Ira. Let's turn to Asia for a bit here. What is demand looking like there right now? We have JKM prices just started trading at a premium to TTF. Do we see cargoes divert there? And then, what does this mean? We have the Japan buying season is coming up. So how do you see demand there? And then what does that mean for Europe?
So I think there was a lot of wishful thinking on the LNG producer side that China would recover strongly this year, and we really haven't seen that yet. I actually just looked at the May numbers before we came on here, and they were more or less a little less than the April numbers, which is part of a seasonal fall off. But if you look year on year, they're kind of exactly the same. So this idea that there's going to be this huge revival, at least from China, we're not really seeing any evidence of that yet. And Tracy, as you rightly said, we saw JKM TTF flip here, and that should send more cargoes, or should divert more cargoes to the Asian market. But the question is, who's going to buy them? And when I sort of broke down the difference between sort of the big buyers like China, Japan, Korea, and even Taiwan versus everyone else, it was kind of an interesting split. The big buyers who have contracts, who actually should have relatively good prices on a contract on an oil index basis, they're the ones who are kind of sort of standing still, and sort of it does lend itself to that sort of slowdown in the economy kind of story, because you have among those big four, you're not seeing any real incremental increases year on year, and in the case of Japan, you're actually seeing very, very sharp fall off in LNG imports. But the other buyers out there, interestingly enough, are on the increase. What we see in Bangladesh, Vietnam, Thailand, these kind of markets actually are growing. Unfortunately, if you're an LNG producer, they're relatively small markets. So on a volumetric basis, they're not growing enough to sort of offset the sort of meh attitude of the sort of bigger buyers. But right now, just the other day, we kind of JKM dropped through fuel oil parity. If it keeps going down, it's going to drop through crude parity. I mean, there's definitely some opportunity here to sort of look at, if there is some demand elasticity to be had as we get into these lower numbers. Right now, so far, we really haven't seen it, but that doesn't mean, it can occur. This is, again, the low point for demand in Asia right now is the second quarter, and we're still, directed into the second quarter right now. And Japan does tend to buy more in the third quarter for its peak cooling season, but their numbers are so low right now, and their deployment of renewables are so high, and their macro is not strong enough that I don't really think you can count on a major Japanese revival here to really get things going. So I don't love it. It doesn't look great. Asia does not have a lot of gas storage, so I still sort of see the incremental LNG cargo pushing into Europe, during the rest of the quarter and into Q3.
And then I want to move back to the U.S. a little bit. So it looks like Manchin's going to get his go-ahead for the Mountain Valley Pipeline, if it's tied to this debt deal. Oh, again. He kind of got screwed on the Inflation Reduction Act. But if this goes ahead, what does this mean for the Northeast in terms of volume and?
So I mean, it's obviously good, because it's a 2 BCF a day increase in potential flows out of the region, which I think is very positive for Northeast producers. But it's kind of like a 10 to 15 BCF a day problem, not a 2 BCF a day problem. So it helps, but the larger issue is still there. And when you hear like Chesapeake talk or EQT talk, they see the future very, very clearly, and the future is really on trying to boost exports and incremental exports of gas, not just out of the region, but out of the country. And so the Mountain Valley Pipeline, from a gas producer perspective, the Northeast helps, but it doesn't. The resource is just so large there that a lot more could be done if a lot more ways could be figured out how to get the gas out of the region.
And then what are your thoughts on, New York's got a new state regulation that's going to force like 627 megawatts of gas and oil peaker plants offline, but they want, they want to retire them all by 2030. I mean, New York already has a problem. What are your thoughts on that?
I don't, even though it's my backyard, I don't tend to look that small. Obviously, that sounds very bad for demand. So, it looks like it's bad for gas demand. You really weren't going to see much incremental capacity to take from the Northeast into New York anyway. So I think it's just more of the same story in the similar direction, which is that, gas, like coal before it. I think there's one coal plant left in the entire Northeast in New Hampshire, if I'm not mistaken. Like coal before it, is weakening, and I just don't see much upside, for demand going forward.
But it kind of leaves New York in a bind as far as energy-wise is concerned, I would think. So we'll see how that goes.
We'll see how it goes. Yeah.
We'll see how that goes.
Yeah, I mean, the Northeast in general. I think if Massachusetts and Maine could work out the deal with Quebec Hydro finally to import more hydro and have that finally work, that would be not only good for the Northeast in terms of balancing power. It would probably be good for Churchill Falls and Newfoundland as well, which is not in a great contractual position with Quebec itself, and Quebec is not going to build out more capacity unless there's a financial incentive to do so, and that the major financial incentive would be exporting more power into the U.S.
Yeah, absolutely. And then back to Dan, I wanted to talk a little bit about offshore, because it seems like people are getting really excited about offshore. I don't know if you guys are, how involved you guys are, but, do you see this as a growth market, say, versus traditional shale?
Yeah, so let's put offshore and international into those categories of much longer cycle. But what we're seeing is, if we think about the last 15 years, right, we had a shale boom, everything went short cycle. That blew up the world. Now we're probably tightening. We're a year and change into a recovery. This recovery is not going to last 2 years. It's going to last 6 or 8 or, some reasonable period of time. The offshore sector has, if we look at spending offshore, they're longer cycle projects. It takes longer to get them going. Once they get going, they usually move to completion. That's where you find big barrels. Look at Guyana and what Exxon and Apache and others are doing down there. It's obvious Hess. You find big new things offshore. So it makes sense that we would start to see offshore pick up. I think if you look at what's happening there from a service capacity perspective, you've mothballed some rigs, you've taken some rigs out of service, so there are fewer rigs, day rates have more than doubled, continues to feel some upward pressure. And again, it just kind of makes sense to me in a world that is going to have a less incremental supply from short cycle shale, that you're going to have some longer cycle resources. So feels like it's a good play. It's slower. It's going to play out over 5 years, not 5 quarters. But it's kind of, you got to spend some time thinking about it. The other thing, and we haven't spent much time talking about energy transition, but your New York discussion around nat gas, and I just think there's a ton of lunacy around how quickly the world can move to a lower carbon future. I think people want it, but just because you want it doesn't mean it can happen quickly. And so, I think it's harder to invest in longer cycle projects because of the overhang of energy transition. But I think, there's still enough visibility. If you think about it, net zero, the goal is 2050 for many countries. I mean, that's 27 years away. You can still spend some money offshore and get it back in a great return. So I think we'll see more of it just because of where we are in the cycle.
Well, ESG was my next question, but attached to this question, so although, do you see offshore you know, what's happening with shale right now obviously is not good for oil field services, right? But do you think that what's happening offshore counterbalances that?
What's happening offshore will counterbalance for the OFS industry for some of the companies. I mean, there are a bunch of North American centric companies, and to me, that's got to be a higher oil price, higher activity story that we just don't have quite yet. Right now, it's going the other direction, right? Rig count, I think, averaged 760 U.S. Land rigs in the first quarter, and it's like 710 right now. So we're going the wrong direction onshore. I think, the specific offshore drillers, some of the big diversified service companies are going to see a nice pop there. It's higher profitability business. It's less competitive. It's higher technology. It's better margin. So there's definitely a positive mix shift that happens offshore. But, if you look at the OFS sector, many of the companies have limited exposure there. The manufacturers have exposure there. That's good. Some of the big international service companies, and then the drillers and the boats are the other two obvious spots.
Thank you. And so energy transition was, don't worry, I was going to get energy transition in. So basically, what are your thoughts on that? Obviously, you think expectations are too high. So how does oil and gas fit in sort of this transition? And also your thoughts on, recently we've seen the likes of Vanguard leave the Energy Transition Banking Alliance, as well as several insurers leave the Energy Transition Insurance Alliance. So do you think the tide is turning a bit as far as oil and gas sentiment is concerned? Because we had a big push for, a while there on ESG, and nobody wanted to insure projects. Nobody wanted to invest in, more projects. And there's still a lot of pressure to do so. But do you think that we are kind of seeing a turn of tide here, maybe a little bit? That was kind of a multifaceted question. I realize that.
Lots to unpack there. I think I'd like to differentiate between ESG and energy transition because they're not the same thing. A lot of people put them together, but to me, energy transition is this push to decarbonize, and ESG is really, there's a focus. There would be a focus on ESG right now, even if there wasn't decarbonization happening. So I view them a little bit differently. I think the ESG wave is cresting. I do not think it's going away, but the actions that you just described by some of the big players, I think there's a realization that the pendulum swung too far, and I think particularly the Russia-Ukraine situation, kind of the energy starvation that happened in Europe last winter is showing people that we've got to have hydrocarbons, and we're going to have them for a meaningful period of time. I do think that the industry has done a good job of they've gone more than they're legally obligated to do in many instances to sort of clean up emissions, methane, CO2, et cetera. And so you look at what the industry is doing. The industry is trying to play ball. The pendulum has probably the momentum in ESG is faltering a little bit here. And so it feels much more reasonable than it did for a while. I don't think it's going away. I think that the good old practical realities, we got a wake-up call. We got two wake-up calls in the last year. One was sort of Europe, even before the Russian invasion, realizing that you turn off too many nuke plants and then the wind doesn't blow, and all of a sudden your power prices, it's either unavailable or prices are sky high. In the US, we saw $5+ gasoline. We need energy supplies. We need conventional energy supplies. And so I think that there is the practicality is creeping into the understanding, whether it's Vanguard or, Jamie Dimon, JP Morgan, et cetera. So I think more practicality is in place, but I think, make no mistake, that decarbonization is the real thing. We are going to, the world's going to push for less carbon. We may have to have, we're going to have oil and gas for a long period of time, but we're going to hit peak demand for oil and gas at some point because all this decarbonization spending will matter. It's just going to take decades, not years. So yes to the ESG, tide turning sentiment, et cetera. Energy transition, though, don't dismiss it because a lot of money is going to be spent, and that is a secular trend. We have a cyclical improvement in the oil and gas business. We have a secular trend in decarbonization.
And then along with that, so what are your thoughts on carbon capture within the oil and gas industry? And do you think that it's really feasible? I know a lot of companies that's what investors and banks want to hear about. And so a lot of people have a lot of projects, but I just wanted to know your thoughts on that.
Yeah, I mean, I think abatement. So I'm a skeptic on net zero by 2050. I don't think there's any way we can get there. Just go read the IEA report on what it takes to get to net zero 2050, and it's laughable. It's not going to happen. Isn't happening. So if we're going to keep producing carbon, which we are, then we got to find ways to abate it. And CCUS makes a ton of sense. The irony, if you look in the US right now, there are many, many projects, CCUS projects in the planning stage and pushing ahead. There are tons of standalone CCUS companies, tons of big oil and gas companies that are ready to do carbon capture projects. They're ready to sequester the carbon. The problem right now is there's not enough CO2 to put away. It's expensive to put on these kind of post-combustion carbon capture equipment. Can cost hundreds of millions of dollars. You got to shut down your plant to do it. And so we've got a heck of a lot more people ready to sequester carbon than we do actual CO2 production. And so that's the irony is everybody thinks, CO2 is coming out of our ears. Well, it's going into the atmosphere. It's hard to capture. And so, people are fighting over the existing kind of pre-combustion volumes that come off things like ethanol plants and whatnot. So CCUS is going to be big. It's also slow. And we got to figure out how the pie gets split between the emitters, the transporters, and the sequesterers, or the storage people. And those folks haven't quite figured it all out yet. So much like everything else in transition, it's got momentum, but it doesn't have a lot of speed.
And then, Ira, we'll continue on the energy transition as well.
Mm-hmm.
Your thoughts on energy transition? I mean, we don't even have the grid capacity right now to support our EV goals. Estimates are that we're going to need over a million miles of transition lines just to support those current goals, not to mention tens of thousands of more charging stations. How possible, what are your thoughts on these goals? How possible is it? And, is it too much too fast?
So I'll start upstream and work our way downstream here. I would say with ESG has had, from my perspective, has had an immense amount of success so far. For one reason only is that it made companies aware of the fact of flaring and venting gas. It made the world aware of it. I mean, satellite and dynamic monitoring has also done that well. And as a result, companies are cutting their emissions. And if ESG hadn't come up as an issue in the past, 5-6 years, I'm afraid that never would have happened, and we still would be flaring and venting immense amounts of gas, and nobody would and the companies really wouldn't care. So I think from that perspective, I think that's been an incredible positive that has come from the E part of the S and the G. I mean, I know this podcast is not about the social and governance part, but when you look at the 20 to 30 criteria that are based on, ranking companies based on the social and governance aspect of it, a lot of companies have taken those quite seriously and made a lot of improvements within all those criteria. But obviously, we're talking about energy here, and the environment, so we'll just stick with that. In terms of transition, I still think, from a policy perspective, given that I work at a policy institute, one of the strongest forms of policy, global policy, that can go forward is really coal to gas substitution, and coal to gas substitution in Asia. That, to me, a lot of work and a lot of movement towards any type of net zero goal, whatever the date will be, could be done if we were to, have policies in place, particularly in Asian markets, where you could have a much stronger substitution between those two things. Now, obviously, it's very expensive to get gas into a lot of these markets, and the pricing point for coal tends to be very low. And if you're going to have, economic growth, relatively low or cheap energy prices is a good way to start. So, but I think, the relationship between those two things are really, really an important area to focus on. And obviously, because the market is long gas, and a lot of the ways Dan talked about, and certainly will be in the second half of this decade, there is a lot of opportunity out there as long as gas and LNG producers can, deliver gas into a price that where if you take a coal or a coal plus carbon number, you can back out those kind of numbers. JC, I don't have much to say sort of on the EV front, not really my world per se. I would just say that the only thing I've ever noticed about this is that that the oil business has had essentially a complete monopoly in the transportation fuels business for 125 years, and obviously there are predators at the gate here, as I call them, and the predators at the gate are the EV, and issues involving whether whether one is better than the other. I don't really sort of get into that sort of world, or but I do think there is an economic opportunity here to build out the transmission you're talking about here, to build out the stations, and you're really just looking at a difference between people who are making money here off of the incumbency of the business and people who want to make money off of something new in the business, and that sort of is always sort of how it lines up for me.
And then going back just a little bit to U.S. LNG, we've got a lot of capacity being built out on the Gulf Coast. So what does this mean for the U.S.? I mean, is there, we have Qatar's got a huge capacity project coming online by 2027. I mean, is there going to be too much gas?
Yeah, I think I think the tightness of the market, and again, like, let's just assume we never see Russian pipeline gas again, or we're not going to see it, for a while. It's still looking, when you start getting into mid to late 25, all the way to 2030, you're talking about adding an immense amount, close to 50 million tons just from Qatar alone, over that period, and where the demand growth is going to come from for all this gas in such a short period of time, I'm not entirely sure. So all of that really suggests somewhat downward pressure on prices. And if you have downward pressure on prices, what's going to happen is that let's call it, the 10 to 12 BCF a day of increase in U.S. volumes that are going to come also over that period. This capacity and U.S. capacity in general is going to end up into the swing supply mode for the market. Just as we saw in 2020 when there was 175 cargoes that were canceled. This is where the swing is going to come from. And so, while there is certainly a view, we can have views on TTF and JKM and how much support there is and how low the prices are going to have to go to create the kind of demand that's going to be necessary to clear the market. One thing I'm darn sure of is that Henry Hub is going to be really, really volatile in this period, because you're going to have periods where you're going to have cargo cancellations, and you're looking at huge BCF a day swings in terms of feed gas demand into these LNG plants going forward. And as Dan, I'm sure, can talk about quite eloquently, the U.S. shale industry and the U.S. upstream is not designed, for those kind of swings. So, on a short-term basis, and movements have to be sort of on a more sustainable basis. So, that's the thing I'm sort of most focused on. That's why I said earlier on, when I was talking about U.S. gas storage, that's certainly an issue. Whether having 4.1 TCF of capacity is enough, and if it's not enough, should there be more, or whether that storage actually be in Europe, or building in Asia. I just put out a paper the other day with my colleague Akos Loj on Ukrainian storage going forward, and how there's a very odd and strange relationship between swing U.S. gas production and Ukrainian storage as kind of the spillover storage capacity for Europe if European storage fills up, or in the future needs to be filled up at a higher level in order to balance. So a lot of moving parts there. It does look soft, as I said, in the second half of this decade, and as we build towards that period right now, it looks okay. Obviously, short-term stuff aside here, where the market's really down in the second and third quarter, the balances are pretty good, but then you start adding these immense volumes from the U.S. and Qatar, and then also let's not forget Mozambique seems to be moving forward as well. It's very, very hard to create that kind of demand growth unless you have much, much lower prices, even lower than the prices that we see today in terms of JKM and TTF.
Do you think that we could see, we have 600 million people in Africa without electricity. Do you think that could be a growth market, especially if prices fall even further?
I think it's possible. Again, it always comes down to bearable price for me, and whether African countries, the policy perspective for countries, at least on the coastal countries, is a choice. And the choice is always, are we going to import more oil and gas, or are we, and subsidize that because the prices have to be relatively cheap there, or people can't afford it, or are we going to subsidize the build out of more renewables? And I think there's obviously going to be some balance between those two, where government policy in Africa or anywhere in the rest of the world has to balance between those two ideas. Not every country needs to subsidize their oil and gas imports, but when you look at incremental LNG demand around the world, outside of China, you are talking about, either choosing to subsidize, growth going forward, to subsidize industry in particular on imported LNG and imported gas, even at lower prices, or, are you going to subsidize the build out of renewables and accelerate that? So it's not a great choice, but those are the choices out there. And as I think with most of these things, that some combination of both is going to happen going forward, and that's how we'll move towards net zero, even if it's not fully reached for 1.5 the 1.5 goal by 2050.
Thank you. And then next we have a couple of questions from Twitter. So first, Dan, this is a question for Dan from Tom Closa. He says, I'd love to hear Dan weigh in on Lionel remaining open through 2024.
I have no value add in the refining space, and so I don't have a good answer to that.
And I certainly do not.
All right. The next question is for Ira from All Things LNG. He asked, my question, what are the odds of developing a global benchmark for LNG trade similar to Brent for oil? And if so, which commodity exchange would take the lead on developing it, or is in the process of developing it?
Wow. Okay, that's a tough question. I mean, the global benchmark is kind of being shared among Henry Hub, TTF, and JKM right now. I still think liquidity has to build in those areas. I do think the LNG cargo market is very, very different than the pipeline market. So the current roles that Henry Hub and TTF are playing in terms of LNG prices are somewhat are not the end game here. I mean, I think some sort of LNG benchmark that's off northwest Europe or in the Med could develop. I think some sort of FOB LNG price, like the Gulf Coast marker in the U.S. Gulf Coast could develop, because I think they're very, very different animals going forward, and I think in a lot of ways they need to be treated differently. And that, I mean, JKM is essentially that. But on the flip side of that, I think other things we could see develop in Asia are some sort of benchmark at some key demand point in China as they develop out their underground storage and their pipeline grid at some landing point within China itself, or potentially another FOB type of benchmark that comes out of possibly Australia, possibly the Middle East going forward. But as someone who used to be in the price assessment business, I can tell you that's as hard a thing to forecast and predict as there is out there.
Okay, and the next question, I guess, is for Dan. It looks like Bobby Compton asked, I'd enjoy your insights if lingering higher interest rates plus restrictive energy policy limits future capex so much that it outweighs the recessionary energy demand destruction. For example, possibilities of long-term structural stagflation energy regime.
Yeah, I do think that demand is relatively inelastic, not completely, but relatively. And so, one of the risks is that from a supply side, that you just wind up, prices are higher and there's nothing you can do about it. We are in a dynamic right now, though, that OPEC's got some incremental barrels, and so I do think that it's tough to see in the next 18 months unless we have we got to move through this recessionary period into a, kind of a recovery period. When that recovery period hits, whenever it is, and maybe that means there is no recession and it's just we kind of bounce from here, soft land or whatever people are talking about. Not my base case, but certainly could happen. Whenever demand ticks up, the spring is coiled. And so I do think there's a risk that you have this, kind of global stagflation issue where commodities are sticky, and it's not just oil. There are other commodities that are going to be pretty sticky. You're seeing copper sell off, but copper's pretty sticky. There's a bunch of commodities that I think are going to be hard to add supply. So if that happens, then a lot of the things that you're seeing in the market right now reverse, and instead of everybody buying, NVIDIA, they come toward Exxon because Exxon's going to have, high levels of profitability, and folks are going to be more comforted by the visibility of those high prices. So that's coming out there at some point. Is it stagflation or inflation? I don't know. I don't even know that we care as energy investors. I think, oil goes from 68 to 88, and you're going to get paid. So I better stop there.
All right. Well, we're coming up in the hour, so we'll do the last round question, which I do for everybody is, first you can make a comment on something that we haven't covered that you would like to talk about, and then also, what as investors should we be looking at, say out the next, 6 to 24 months, what should we really be keeping our eye on? And either one of you can start with that.
I'll go first. I would focus on what I call investment in demand growth. I think as Tracy, as a lot of the questions you're asking, a lot of what we've been talking about over the hour, this always seems to happen where there's a huge focus on supply growth and investment in supply and then more supply. But as I've always jokingly said to anybody who's listening here, but we've talked about this, is that in 30 some years of doing this, I've met the vice president of every person in a company that you could have a job for, of supply, of production, of exploration, of marketing, and I've never met the vice president of demand in a gas company. And so the larger point here is that there is an inequality between the investments being made to produce more gas relative the investments being made to consume more gas. And so what I would tell people to look out for there is to look out for countries, look out for companies out there who are investing in the opportunity of burning more gas forward, whether that's coal substitution, whether that's underlying demand growth, whether that's more of a petrochemical build out, or whether that even largely this is only true in China, any kind of build out within the RC grid. That's a key area to look for me going forward, because I do think the market is going to be kind of long gas, and it's going to be kind of long gas for a while, and then the opportunity really is out there really in two areas, to invest in consuming this gas in a competitive way that allows you to have margins on whatever product or whatever you're using it for, whatever fuel you're going to use it for, and the storage aspect of this, which is that that the world is moving towards where the incremental volume of gas is moving on an LNG cargo tanker rather than moving across borders on a pipeline. And so that very much changes the dynamics of how gas is going to trade and how the globalized gas of price is going to trade, and how Henry Hub, TTF, and JKM and all of the subsequent benchmarks relate to each other going forward.
And then Dan, same question, cover anything that we didn't cover that you would like to talk about, and what should we be looking at, for over the next 6 to 24 months, which could we be keeping our eye on?
Yeah, carte blanche question. I love it. So I think for energy, my comment to investors is this is really a time to kind of investor know thyself. If you are, you got to get paid in the next quarter, then you got to be trading like crazy. I actually think we have a cycle here that's going to have significant duration. If you think about 2014 to 2021, that was our down cycle, 7 years. It lasted a lot longer than anybody thought. This up cycle is going to last longer. It's going to have fits and starts, pauses, et cetera. We're in the middle of one of those. I do think that the discipline for the sector is going to be sustained. Companies are not going to try and grow organically until investors tell them it's okay, and I do not see investors ready to tell them it's okay to grow. That will come. That's the back part of the cycle that we haven't, gotten to yet. Typically, cycles end with enthusiasm. It ends with cheap and available capital. It ends with companies outspending cash flow. It ends with retail investors getting involved. We don't have any of that stuff yet. And so when I look at our business, on the private side, we're aggressively trying to deploy capital here in the upstream in North America because we think we've got price upside and ultimately volume upside. And so, we want to be involved. I generally want to be involved in the energy sector, although I think it's kind of choppy in the near term. You switch over to energy transition, and there, as I mentioned earlier, I think that's a secular story. I'm kind of investing time right now, not money, in the energy transition sector. I think that we're going to have 100 more energy transition public companies 5 or 6 years from now. I think we're going to talk about those companies a lot more over the next 20 years. But right now, they don't make very much money. They need capital. A bunch of them are going to go broke. And so it is a really choppy and challenging space. So I like investing time as opposed to dollars in the energy transition. So know yourself and what your objectives are. Think about a long cycle in the hydrocarbon business, and think about, trying to come up the curve on various energy transition technologies so that you can invest in them, in the 2030s. Those would be my concluding thoughts.
Thank you. And thank you both for spending the hour with us today. I really appreciate your insights, and you gave us a lot of information to digest. I love it. I would follow both of these guys on Twitter. They post great stuff. And follow Place Your Trade so you know our upcoming events. And that is it. Thank you again, gentlemen. And I'll see everybody next Wednesday.
You're welcome.
Tracy,
Thank you
thanks
very
a
much.
lot. Appreciate it.
Yeah, appreciate it. Thank you.